Welcome to The Debate. Today, we are dissecting one of the most high stakes, frankly, anxiety inducing rituals in the startup world, the cold email to an investor. That precise, terrifying millisecond where someone decides to either open your pitch or just banish you to the digital void of the trash folder.
Yeah, it is the moment where dreams collide with the delete key, and usually the delete key wins.
It does. It really does, which is statistically accurate. Specifically, we're debating a controversial, maybe even radical set of data released by StepUp.One. Now, for context, StepUp.One runs fundraising outreach at a massive industrial scale. We are talking about thousands of pitches sent to investors every single day. And their findings are brutal. They argue that the entire playbook early stage founders have been taught, storytelling, relationship building, crafting a narrative, is not just inefficient, it is entirely wrong.
And I am here to, stop us from turning the art of fundraising into a soulless spreadsheet exercise. StepUp.One effectively argues for the industrialization of the pitch. They say, investors buy momentum, not poetry. I will be taking the devil's advocate position today, arguing that while efficiency is nice, if you strip away the poetry, the vision, the narrative, the human connection, you might get a meeting, but you will not get a partner. Early-stage venture is about marrying the investor, not just taking their money.
And that is exactly the tension we are exploring. I am representing the StepUp.One position today. That in a saturated market, ruthless brevity and hard metrics are the only actual signals of competence.
And my contrasting perspective is that founders are not algorithms, and neither are investors. Reducing a company to a strict set of traction metrics is a dangerous oversimplification. I will argue entirely for the narrative approach, regardless of traction metrics, because treating this process like a transaction kills the potential for outlier success.
All right, let us get right into the thick fit. The reality StepUp.One presents is one of overwhelming noise. An average VC associate reviews hundreds of deals a week. StepUp.One tested the traditional advice, writing custom intros, referencing portfolio companies, trying to be witty, and the result was zero impact. Literally, statistically zero impact on meetings booked.
Which is a staggering claim.
It is.
You were telling me that doing my homework and establishing context is statistically irrelevant?
I am telling you it is inefficient, yeah? The StepUp.One philosophy is very clear. If your email needs effort, it dies. They found that the only variables that positively correlated with booking a meeting were, 1, a ruthless one-line description of what you actually do, 2, placing hard traction metrics right at the top, and 3, removing every barrier to booking the meeting. They argue that founders use storytelling as a crutch to hide the fact that they don't actually have a real business yet.
I understand that perspective, especially since our audience today, early-stage founders, absolutely typically overestimate the value of their narrative. They do. But this data-driven view assumes the asset being sold as a financial instrument with a predictable yield, right? Like a bond.
Exactly.
But a startup, especially at the pre-seed or seed stage, is a belief system. You cannot quantify a paradigm shift. If you look at the early days of Airbnb or Uber, the metrics were laughable. The traction was messy. The only thing that made them investable was the narrative, the poetry of how the world would fundamentally change. If you force those visionary founders into the StepUp.One template, they just look like failures. You optimize for clarity, sure, but you filter out the magic.
Well, magic doesn't pay the bills. Revenue does. And this brings us to the first major pillar of the debate, momentum versus poetry. StepUp.One is explicit here. They say investors buy momentum, not poetry. They list the data points that must replace your narrative paragraphs: ARR, growth rate, retention, and the ratio of LTV to CAC.
Let's actually pause and define those for the audience, because throwing acronyms around is exactly how founders confuse themselves in these emails.
Fair enough. So ARR is annual recurring revenue. How much money are you contractually guaranteed to make in a year? LTV to CAC is the golden ratio, lifetime value of a customer divided by the customer acquisition cost. Basically, if I spend $1 to get a customer, do I get $3 back? StepUp.One says if you have these numbers, put them in the first sentence. If you are writing a philosophical essay about connecting the world, it is almost always because your numbers are bad.
Right, but this is a massive catch-22 for the vast majority of early-stage founders. This is where the Step Up One logic feels incredibly cold. They say investors buy momentum. I agree. Investors love momentum. It feels safe. But what if you are day one?
You still have
No, wait. If you don't have an LTV because you do not have a customer who has stayed for a lifetime yet, you don't have ARR because you are still building the BEA, if you strip away the vision, the poetry, what is left? Literally a zero on a spreadsheet.
See, this is the most common excuse I hear. Founders say, I am too early for metrics. Step Up One addresses this head on. Momentum isn't just revenue. Momentum is signal. Even pre-revenue, you have metrics. How big is the wait list? What is the open rate on your newsletter? How many previous exits does the founding team have?
But waitlists are vanity metrics. We all know that. A waitlist of 10,000 people who haven't paid you a dime is just a list of email addresses.
It is better than a blank page. The point is investors are pattern matchers. They are looking for reasons to say no just so they can get through their inbox. If you present a wall of text about your mission, the immediate psychological reaction is high friction, delete. If you present a bullet point that says, 3x Google founders, 5,000 person waitlist, beta launches Monday, that is momentum. You do not need poetry to sell that.
You are describing signal, not momentum. And I agree that credentials help. But I worry about the founder listening to this who doesn't have the ex-Google badge and doesn't have the waitlist yet, but has a genuine breakthrough idea. Step Up One effectively tells them, don't bother emailing until you have the numbers. But you need the money to get the numbers. The poetry, the careful articulation of the problem is how you bridge that gap. By stripping it out, you are essentially saying that only people who are already successful deserve funding.
I am saying that people who cannot quantify their progress deserve scrutiny. Step Up One's core point is that poetry is usually a hiding place. It is where founders go to obscure the actual mechanics of the business. If you are building a breakthrough, tell me about the mechanics of the breakthrough. Don't tell me it is revolutionary. Tell me it increases efficiency by 10x. That is a metric, that is momentum.
So we are just redefining poetry as fluff. I can agree that fluff is bad. But let's look at the next pillar of their argument, which creates a very different kind of problem. Ruthless brevity.
Oh, this is my favorite part, the one-liner. Step Up One mandates a single sentence covering market, customer, pain, and solution. Their rule is rigid. If I cannot explain the startup in one sentence, we do not send it.
And for a B2B SaaS company selling accounting software, that is perfect. We help accountants close books faster using AI. Great, I get it. But let's talk about the hard tech dilemma. What if you were building a decentralized governance protocol, or a new type of biological manufacturing process, or a literal fusion reactor?
The exact same rule applies. If you can't explain it simply, you don't understand it well enough.
I completely disagree. If you force a highly complex, novel concept into a single sentence, you strip away the nuance that makes it valuable in the first place. You end up sounding entirely generic. If a company says, "We are curing cancer," that sounds like a scam. If they take 3 carefully crafted sentences to explain the specific, novel mechanism of action regarding T-cell receptors, that sounds like a scientific breakthrough. Ruthless brevity favors the familiar. It favors Uber for dogs. It punishes the truly alien ideas, which are, historically, the biggest returns.
I think you are confusing complexity with confusion. Step Up One isn't saying the business itself isn't complex. They are saying the hook must be simple. If a founder cannot distill their value proposition down to, we help this customer solve this pain by doing this solution, they have not achieved product market clarity.
Or they understand it too well to insult the investor with a reductive soundbite.
But investors want the soundbite. They need to categorize you mentally. Okay, this is a biotech play in the oncology space. Once they have you in the correct mental box, then they can open the lid and look at the complex breakthrough. But if you start with the complexity, you never get in the box. You get archived. Step Up One argues that nuance is for the meeting. The email is just for the hook. You don't write a dissertation to get a first date.
But you also don't propose marriage on a billboard. There has to be a middle ground. My concern is that this strict template approach commoditizes the founder. It treats the human interaction like a transaction at a vending machine. Insert one-liner, dispense meeting.
Which leads us perfectly to the most controversial finding regarding human interaction: the zero impact of personalization.
Yeah, this is the part that feels most counterintuitive. Every blog post, every accelerator tells you, do your homework. Researching the investor shows respect.
And Step Up One says it is a complete waste of time. They tested it at scale. They sent emails with lines like, I saw you invested in company X, or I loved your recent post about AI, or as you focus on fintech.
And the result?
Zero impact. It did not increase the open rate, and it did not increase the reply rate. In fact, Step Up One argues it often hurts the founder because it smells like business development spam. It feels fake.
Well, fake is the operative word there. I think Step Up One is conflating bad personalization with no personalization. Their dismissal is way too sweeping. I agree that saying, I loved your blog post is transparently transactional. It is cheap flattery.
But what is good personalization then? If mentioning their past investments doesn't work, what does?
Deep sector alignment. It is not about flattering the investor. It is about establishing context. If I am pitching a marketplace for vintage clothes, and I reference that you are an early investor in The RealReal, a luxury consignment site, I am not flattering you. I am anchoring my business to a mental map you already possess. I am saying I fit into the specific thesis that you have already bet on. Modern investor relationship building relies on that alignment.
But Step Up One argues that if your one-liner is clear, that alignment is completely self-evident. If you say, we are a vintage marketplace to a marketplace investor, they know they invested in The RealReal. You telling them that they invested in it is just you saying, look, I know how to use Google. It comes off as insecure. It signals that you need their attention more than they need your deal.
That is a remarkably cynical view of human psychology. Humans are creatures of ego, even VCs. Acknowledging that I have selected you specifically creates a social contract. It says, I am not spamming 5,000 people. I am talking to you.
But you are spamming 5,000 people. That is the reality of modern fundraising. It is a numbers game. Step Up One is just admitting the truth. The social contract you are talking about is a myth founders tell themselves to feel better about the constant rejection. The investor does not care if you read their thesis. They care if your growth rate is 20% month over month. If the numbers look like a rocket ship, you could address the email to whom it may concern, and they would still take the meeting.
So we are just stripping away all social graces. We are turning a partnership into a ticker tape of metrics.
We are respecting their time, which brings us to the actual mechanics of the email. The ask. This is where StepUp.One advocates for extreme friction reduction. Two very controversial tactics here: the full deck up front and the immediate Calendly link.
Both of which make traditionalists scream. Let's start with the deck. The old school advice is send a teaser, a 3-slide PDF that gives just enough information to make them want more. You force them to reply to get the full deck. It creates intrigue, and frankly, it protects your proprietary information.
And Step Up One says, stop playing hard to get. If you send a teaser document, you are creating a hurdle. The investor reads it, maybe likes it, but now they have to type a reply, ask for the deck, wait for you to send it. That is 3 days of latency. In those 3 days, 5 other deals have crossed their desk. Step Up One's strict requirement is put the DocSend link to the full deck right in the first email.
But what about the risk? If I send my full deck to 500 investors, my entire strategy is public. My competitors will see it. It feels completely reckless.
That is founder paranoia. Execution is the moat, not the slide deck. If your business can be killed because someone saw your slides, you do not have a real business. The teaser strategy assumes you are the center of the universe and everyone is dying to talk to you. The reality is you're one of 500 people shouting in a crowded room. If you don't show the goods immediately, they walk right past you.
I can actually concede on the deck. The friction argument makes logical sense there. But the Calendly link and the explicit terms, that feels incredibly aggressive.
Decision takes 10 seconds. If interested, they book. That is the quote.
It feels presumptuous. It says, here is my slot, fit yourself into my grid. In high-level networking, sending a calendar link immediately signals that you are junior,
or that you view the recipient as just a commodity. It lacks the grace of a softer initial engagement strategy, like asking, "Are you open to a conversation?"
Are you open to a conversation creates more work. Now the investor has to reply yes. Then you reply with times. Then they pick one. Step Up One calls this calendar ping pong. It is death by 1,000 emails. The Calendly link is not arrogant. It is highly efficient. It says, I know you are busy. If you like what you see, click this and we are done.
Or it filters for investors who are actually engaged enough to type a single sentence. I would argue that calendar ping-pong is a valuable signal of interest. If an investor is willing to go back and forth with you to find a time, they are genuinely interested. If they just click a link, they might cancel 5 minutes before the call because it was simply too easy to book. You are optimizing for volume of bookings, not quality of engagement.
Well, Step Up One doesn't stop at the link. They want the explicit ask. They don't just want a link, they require strict guidance to specify the round size, the ticket, and the timeline immediately. We are raising $2 million, tickets are $500K, we close in 3 weeks.
We close in 3 weeks is a bluff that most early founders absolutely cannot back up.
It creates urgency.
It creates a deadline for failure. If you say we close in 3 weeks and you don't close because you are pre-seed and nobody knows you yet, you look like damaged goods. Soft engagement saying we are opening our round soon allows you to test the waters, build demand, and then set the terms. The Step Up One method requires you to be in a position of strength that many founders simply are not in yet.
Faking it until you make it is bad advice. Step Up One is saying, define the reality. If you don't know your round size or timeline, you aren't fundraising, you are coffee chatting. Investors don't want coffee chats. They want deal flow. Ambiguity kills deals.
And I think they want both. They want deal flow, yes, but they also want discovery. They want to be courted intellectually. The Step Up One approach feels like a cold transaction. It treats the founder-investor relationship like buying a used car. Check the mileage, check the price, click buy.
And your approach feels like a courtship at a Victorian ball. It is lovely, but it is inefficient and highly likely to end without a marriage if you don't actually have a dowry, which in this case is the hard data.
A fair analogy, but sometimes the dowry is the immense potential, not the cash currently on hand.
We need to bring this to a close. We have outlined 2 very different philosophies today. One is the industrialized pitch, optimized, metric-heavy, low-friction, driven strictly by the Step Up One data. The other is the narrative pitch, vision-driven, relationship-focused, allowing for high nuance.
Right, and I want to summarize my core concern with the Step Up One method. I do not deny their data. I am sure it is incredibly efficient at generating volume. But my fear is that founders will read this and think they need to become robots. They will strip the soul out of their company. They will stop trying to articulate the why and focus only on the how much. And for an early-stage founder, the why is often the only unique asset they have. Narrative is a superpower. It is how you recruit, it is how you sell, and yes, it is how you raise. Do not trade it for a statistic unless that statistic is undeniable.
And I will summarize by reaffirming the Step Up One position. Early-stage founders are often their own worst enemies in outreach because they are obsessed with how they want to be perceived, rather than how investors actually consume information. The data speaks louder than preference. Founders overcomplicate. They hide their numbers because they are scared their numbers aren't good enough yet. They write massive essays because they think length equals depth. The discipline of presenting rather than impressing is the key takeaway here. Efficiency isn't cold, it is respectful.
I suppose we can agree on one crucial thing. Clarity is non-negotiable. Whether that clarity comes from a chart or a compelling story, if the investor does not understand it in 10 seconds, you have lost.
Agreed. But I would always bet on the chart.
And I would bet on the story that explains the chart.
An endless struggle. We encourage you, the listener, to look at the source material and consider where your own strategy falls. There is clearly much more to explore in how we balance metrics and magic. That is all for this session of The Debate.
Until next time, keep building.